Most people freeze when the economy turns uncertain. They stop investing, pull their money out of the market, and wait for things to calm down. But here is what they never tell you. Some of the greatest fortunes in history were built exactly during those moments of chaos, confusion, and fear. The people who understood this did not run from uncertainty, they ran toward it. And today, that same opportunity is sitting right in front of anyone who is willing to learn how to use it. Understanding why uncertainty is actually an opportunity. The word uncertainty makes most people think of danger, and yes, economic downturns, rising inflation, and market crashes can cause real financial pain. But uncertainty works in two directions. It punishes those who are unprepared, and it rewards those who are ready. History makes this crystal clear. When the 2008 financial crisis hit, markets collapsed and panic spread across the globe. Millions of people sold their investments at rock-bottom prices, terrified of losing more. Warren Buffett did the opposite.
Students that come, they're going to graduate schools, and
he poured billions of dollars into beaten down companies like Goldman Sachs and General Electric when almost no one else would touch them. The result? Massive gains when markets eventually recovered. Buffett famously described his approach as being fearful when others are greedy, and greedy when others are fearful. That single principle has guided one of the greatest wealth-building stories the world has ever seen. The key insight here is that uncertainty creates a gap between what things are worth and what they are currently priced at. Assets get undervalued. Businesses become available at a discount. Real estate softens. For those with a clear strategy and steady nerves, this gap is where real wealth is created. What separates the wealthy from everyone else in these moments is not talent or luck. It is preparation. Before uncertainty even arrives, they have already built the financial foundation to take advantage of it. That foundation starts with something simple: knowing where you stand financially. Understanding monthly cash flow, total debt, and existing investments is not glamorous work, but it is the starting point for every single move that follows. Without that clarity, even the best opportunity in the world becomes impossible to act on. The second thing to understand is that not all uncertainty is the same. There is market volatility, which is short-term noise. There is recession, which is a deeper slowdown in economic activity. And there is inflation, which quietly erodes the value of saved money over time. Each of these forces calls for a slightly different response. But there is one strategy that works as a powerful defense against all three, and that is diversification. The core strategies that build wealth when markets are shaky. Diversification is not just a buzzword thrown around by financial advisors. It is the single most proven method for protecting and growing wealth across changing economic conditions. The idea is straightforward. When investments are spread across different asset classes, stocks, bonds, real estate, and alternatives, a loss in one area does not wipe out everything else. Ray Dalio, the founder of the world's largest hedge fund.
Machine works. In other words, I believe the economy works like a machine. I believe most things work like a machine. I'm a market participant. I'm a global macroeconomic investor.
Bridgewater Associates, built his entire investment philosophy around this concept. His famous all-weather portfolio was designed to perform reasonably well in any economic condition, whether the economy was growing, shrinking, or experiencing inflation. Dalio believed that no one can consistently predict what markets will do next, so the smartest move is to build a portfolio that does not need a prediction to succeed. His approach turned Bridgewater into a multi-billion-dollar operation and made Dalio one of the wealthiest investors alive. Diversification also means thinking beyond traditional investments. Real estate, for example, has historically held its value far better than stocks during periods of economic stress. Even when markets are falling, physical properties generate rental income and tend to recover their value over time. For those without the capital to buy property outright, real estate investment trusts offer a way to get exposure to the real estate market without needing to own a building. Beyond diversification, one of the most powerful wealth-building tools during uncertain times is an emergency fund. This is not the most exciting topic, but it is critical. Without a financial buffer, any unexpected expense, a job loss, a medical bill, a car repair, forces a person to either take on debt or liquidate investments at the worst possible moment. Financial experts broadly recommend keeping at least 6 to 12 months of essential living expenses in a high-yield savings account during periods of elevated uncertainty. This buffer does two things. It protects against short-term financial shocks, and it gives the confidence to stay invested in the market when things get rough. Speaking of staying invested, this point cannot be stressed enough. One of the most damaging mistakes a person can make during a market downturn is pulling out of investments in a panic. Data consistently shows that missing just a handful of the stock market's best performing days dramatically reduces long-term returns. The problem is that those best days almost always come right after the worst ones. The investor who exits during the crash misses the recovery entirely. Then, there is the concept of building multiple income streams, something that wealthy individuals across industries have understood for generations. Oprah Winfrey did not build a billion-dollar empire through a single television show.
36 Academy Awards. She opened the envelope and said 5 words that literally made history.
She expanded into production, publishing, media networks, and investments. Jeff Bezos did not stop at selling books online.
You could have a job, or you can have a career, or you can have a calling. And the best thing is to have a calling.
Alongside consistent investing, the habit of living below one's means remains the unglamorous but undeniable engine of long-term wealth. Every unnecessary expense is money that could have been compounding in an investment account. This does not mean living poorly, it means being intentional, reviewing monthly subscriptions, negotiating bills, and redirecting even small amounts toward investments or debt reduction creates a compounding effect that grows significantly over years and decades. Debt management also plays a major role during uncertain times. High-interest debt, particularly credit card debt, is financially corrosive. It grows faster than most investments can keep up with. Every recovery has rewarded those who stayed prepared, stayed invested, and stayed disciplined. The question is never whether the economy will improve, it always does. The only real question is whether a person will be positioned to benefit when it does. Start building that position today.